This video in our market structure series is about second entries. Remember, the whole purpose of this playlist and this series is to define different constructs in the market that we use as a framework for either identifying where to enter or understanding what market state we're in. And without a framework, you don't have a predictable way to assess and understand the market, and therefore all of your behaviors will be random and much less likely to succeed. With the framework, we understand how to conceptualize the market, and we understand how to execute our trades once we get into the trading strategies. So this one is about second entries. In order to understand a second entry, we kind of need to understand what is the first entry and what causes that. So as the market comes to a specific place, there are participants that have a need to either enter or exit positions there. The first entries are usually reserved for longer term time frames, or people with enormous money, or people who don't necessarily care if the price responds immediately. They always care, but they have the ability to withstand some level of drawdown. Because we're trading high margin accounts and intraday, normally we're going to be looking for secondary entries. And that's an entire classification of traders. So everybody who's trading on a high margin account that can't withstand large drawdowns, or is looking for a higher probability setup that's going to allow them to enter the market more safely, is waiting for the market to respond to a certain level. And then once that response happens, they then enter their positions. And when they do that, if there's a strong attempt there, we can see evidence of that on the chart, and then we know that something has happened. And when that something has happened, how the market responds to that then allows for us to execute our trades, to understand what the market's doing, and then gives us the market regime or market state, which then gives us the directive to execute our trading strategy in that certain market state. Certain trading strategies work basically 100% of the time in certain market states, and then they work none of the time in other market states. So without understanding the current market state, you're going to be guessing and betting way lower than you otherwise would be. And if you do understand the market states, you improve your odds of success very significantly versus not understanding them. So the first entry, you can look at the chart and say, like, let's say that this market's just trending down right here, right? This was the first attempt to have a successful long trade. We'll just draw the low right there. Once the market comes up above that, the first type of secondary entry we have is a trend continuation. So we see that there's a low here, and the market pushes up above that. Then we hit what's a responsive buyer. The people who are looking for, they think this is a longer term area, and okay, the market's responding to it. And then right here, they put that in as a second entry. So that's the low of the second entry right there. And then we can draw a box and just say that this entire construct is the secondary entry, and then the push up above that is the secondary entry of this trend continuation. And in this case, I'm talking about the uptrend here. This is obviously a more major downtrend. And we see that that happens, depending on what time frame we're looking at, all over and on both short and long-term time frames. So often the markets are in conflict where this is a major downtrend, and we could have called that the second or the first entry for the long. And I just picked that because it's obvious to see on the chart. But then what we see here is this is actually the more major second entry for this downtrend. So let's say that the downtrend started here, just for the sake of saying that. The secondary entry there, we see that the market pulls up over to here and then it pulls back. This is the second entry for this start of the trend. And you can see that as we're defining these, they're kind of all over the place. And we use this as like really just reading the market to understand what's happening. So we have, like, in this case, first entry and second entry for that. And it's happening again in different places. So, first entry here, possible second entry there, first entry here, possible second entry here. And we have to understand that the idea of a quote second entry is fluid, and it's in reference to a different point. We're just looking for a continuation, an indication that the market has attempted again to try to go in a certain direction. And then we identify that, and then how the market responds to that gives us an indication of how we should be behaving in that area. So if we go to this chart, we can see, like, let's say this is the start of this uptrend here. This is the first entry. You can draw this leg here. You see it starts here and never really pulls back until maybe we get to here and we have a retracement for a couple minutes. This level here then would be the second entry in this trend, because the market stalled here at the bottom and then continued up. We can call that whole leg the second entry of that. And that's the first type. It's a trend continuation level. This, again, happens all over the place. And we're looking at this chart, we can see that it happens here in the short level. So this, we'll call this the first entry, this push here. And then in this, there's a second entry on the shorter term time frame right here. First push, second push down. And then in reference to this top, we can actually just move this over here and say this is the second entry for that. Now, which one is the second entry for this construct here? Well, it kind of depends. It depends on what we're looking at. This is a first entry here. This is a second entry here. And then we can see that once this goes above this, so we'll just call this, really they're all in reference to each other. So first entry there, second entry here. It doesn't really matter how you count. What we're doing is we're trying to look for secondary or subsequent attempts to sell. So all of these pushes, you can identify them by these big structures here where the market responds to it. There's a push from a new swing high all the way down to the low, and you can just see the price structure there. All of these are secondary attempts or subsequent attempts to sell this. So you might call it 1, 2, 3, 1, 2. It doesn't really matter how you count. What we're looking for is evidence on the charts that a trade has been placed and the market had a response to it. And then how do we use this later? Well, you can see that once this secondary entry breaks above that, the market comes up and then it comes back to it, and that functions as support. And we can look at this as an area to potentially enter a trade, or an area that we should be aware of as the market's moving around. We have this as a reference location, and then we execute behaviors in that location. So for the sake of definitions, I've defined just 3 different types of this. We have trend continuation. So let's say like this is the bottom of this. This then here, this that was drawn poorly. Let's say this is the first entry right here. It's the low of the start of the uptrend. And then we can call this right here the second entry for that uptrend. This can happen on a shorter term time frame. Like this is a big push up here. This is maybe a better example. But this pushes up here, and then where's our second entry long? It's this leg right here. And we can then draw this as a reference point and understand that as the market is above this, the uptrend is intact. And then you can see here, if we call this the start of the end, or the start of the end, the start of the trend, then this entire area here would be the second push up, and then we might call it this leg here. What we're identifying is this is evidence of buying activity, subsequent continuation of the trend. We also see this in the down direction here. Let's call this the top, the first entry, the big push there. And then there's a congestion here, and then this right here would be the second entry of that. And then this would be, if we call that the first entry from this double top, depending on really where you're calling these tops, that's a second entry of this. This is a second entry of this. And this is a second entry of this. So maybe second entry isn't the right verbiage. The entire idea here is that we're trying to find subsequent attempts where the market has pushed itself in the same direction. So if we call this a top, we'll just draw this little circle right here. We'll call that the start of this. Maybe we call that the swing high. This right here would be the secondary attempt to hold that. The market comes back up here and we see a big push there. That worked for a while. And then that's an area of support later once that fails. Or if we wanted to sell this, we wait for the market to come back up here and then enter in the direction of that. We wait for a response and then enter there. So you might be asking, like, what's the point of this? How do you use this? And for the sake of this video, we're really just defining what this is. There's been a couple examples of behavior that I just briefly touched on in this. But the point being, we should look for these levels, and if we're trying to figure out where we are in the market in reference to trades that have been placed, and we're reading between the lines here, we can just see that we should just be drawing them. And how do we draw them? Well, that's going to be up to you to learn and practice. They're all over the place because of the market's fractal. In this case, all of these big up pushes, like we're looking at these green candles now. So this is the first push. This is a second entry here. The market pulls back here. This is a second entry here. In this shorter term time frame, like let's say you're on a 15-second chart. This is a 1-minute chart now, but if you're looking here, this is the first entry here. This is the second entry there. This is the low here. This is a second entry here. There are levels where the market has hit that and then attempted to come up, and we can look at the chart and see a collection of bars, like 3 green bars in a row here, that imply that's a second entry. And then once the market fails that, the trend has reversed. So we have trend continuation. We have double tops or double bottoms is the other type. Let's call this the first top here. This would be the second top there, and then the push from there is a second entry there. So trend continuation would be, in the case of this moving down market, we have one, and then that's a second entry. It's another entry, subsequent entry, subsequent entry. And then once that subsequent entry fails, the market has reversed there. That's the first one, trend continuation. The second one is a double top or double bottom, which is like a response to resistance or support. So this is a swing high here. Once the market has started its push down and there's a start of a trend there, this is the start of that second entry short, and then this entire leg here is the second entry of this trying to hold that double top. The third type, which is a very powerful type that we really need to be aware of, is it's really a third attempt most of the time, but it's a last ditch attempt to hold the top of a range, which I'll just say it again without getting into too much details. It's a very strong pattern. So if we have first attempt there, second attempt there, this is the second attempt here of the double top, which is, there's 3 of them now, but this level is critical because it's a range breakout on a higher time frame. So if we just draw this as the entire range down here, top, 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 this construction here is a very critical level. It's the third type of subsequent entry or secondary entry, which is defined as the last attempt to hold a range. And we can see that even on a shorter time frame, how the market's fractal. If this is the push down here, this is the second attempt here. In this case, this right here would be the last attempt to hold that range. So we have multiple examples of that. Big push, bigger range, last attempt to hold the range. And in this case, last attempt to hold the range in that smaller push. So we have like a multiple stacking up confluent structures. And lo and behold, it's a very strong support level. So just another very brief indication of how to do that. If you're looking for more information on how to build these into a trading strategy, well, we'll get to that. Feel free to message me about all of that. But right now, we're really just trying to define the structures. There's more structures, a couple more I need to make videos on. But what this does is it gives you a roadmap and a framework to create an idea of how to understand this, which is like a collection of squiggles and crazy stuff. That what is this? How do we interpret this? And we make it into something that you can actually just execute trades inside of and make money. So I hope this was helpful. If you do like this video, please like and subscribe to it. If you have any ideas on different types of content or how to improve this or what would be most relevant to you, please do let me know. And I will continue to make these videos because I'm trying to establish this for you and for my sake so that we have something to work with here. Thanks again. Thanks for watching. I hope this was helpful.